Right. So it's a way that we actually separate costs, categorize costs into fixed and variable. And the fixed costs would be costs that doesn't change over the short run. So whether production are up or production are down, those costs won't change. While on the other hand, variable costs will change with production. So if you're not producing, variable costs will be low. So for example, the company may choose to in a time of low production to reduce its labor, its factory labor, so as to reduce that variable cost as production goes down, while it will be unable to reduce that lease on the factory. So it will be a company will stick with having that fixed cost. All right, so the first question tells us that the company has a variable cost of $15 per unit, and it has a fixed cost of $80,000. And it says compute the break even in units. So bear in mind also that break even can be calculated either in units or in dollars. So you could receive a question that says, what's the break even in units? Or you could receive a question that say, what's break even in dollars? And so you should be aware as to how to calculate either of them. Okay, so compute the break even in units. So break even units will just be our fixed cost over our contribution margin. And how did we say you find contribution margin? Contribution margin would be price minus variable cost. And in this case, we're using contribution margin per unit. So I'm trying to share here now. All right. So are you guys able to see my screen now?
Yeah.
Yep.
Okay. All right. So if we're finding break even in units, so if we have here break even would equal to, as we say, it would equal to fixed cost over contribution per unit. So it would be the price of the goods minus the variable cost of that goods per unit. So variable cost. And so with regards to an example, we know fixed cost would be 80,000. And we know that variable costs would be, well, contribution margin would be $20 minus $15, which is the variable cost per unit. So that's equal to 80,000 over $5. And that gives us, and this should be $80,000, right? $80,000. And that would give us around 16,000 toasters. So 16, let's clear this. So 16,000 toasters. So that's the first part of that question. Just using the formula for break even. So for the second part, we are to prove or to show that it says fill in the table below to illustrate that the break-even point has been achieved. So we just find the profit or the loss. It says total operating profit or loss, and that total operating profit or loss should be 0. Okay, so I have here. Why is this thing going so slow? Oh, what's going on here? Are you guys hearing me?
Yep.
No, yeah, we are now.
My screen seems pretty slow. I don't know if I'm having a computer problem. Let's see what's. Let's give me a minute here. I'm just checking something here. All right, so let's see if it's. All right, so we have sales. Come on, let's go. All right, so we have sales of, and our sales would be 320,000 based on a sale of 16,000 units, which is a break even at $20 per unit. So it's 16,000 at $20. I hate when this goes so slow. I'm not sure what's happening here. It's fine. Okay. All right, so we have 320,000. Then this is going to less variable cost. Variable cost of, so it would be the same number of units of 16,000. And this would be by 15. And so this would be 240,000. So this would give us our contribution margin. And our contribution margin would therefore be 80,000, which means that our fixed cost would be the same as our contribution margin, and hence break even profit would be 0. So that's 0 profit. Okay, so that is showing that the profit, are illustrating it as the question asked you. All right, so let's take a look at question 2. So in question 2, the question is that Harman Corporation manufactures bat with Lara Walker autograph stamp on them. It says each bat sells for $25 and has a variable cost of 14. There's 40,000 in fixed costs involved in the production. A, calculate break-even point in units, and B, find the sales in unit needed to earn a profit of 30,000. So, all right, so given that I have done the first question, I'm gonna let you guys go at the second one. So I'll give you 5 minutes. Are you guys hearing me, by the way? Because I'm not hearing anything. It's just so quiet.
Yeah,
We're hearing you.
Okay. All right, you guys are finished?
Few more minutes.
Okay. All right, so what do you guys get for your answer for A? Any answer for A?
I got
3,636.
Yep.
Okay, that's fine. And B?
I got the same thing, 3,000.
6,000.
No, that should be more. It should be more, right? Because now you have to make a profit, so you have to sell more units.
Are we doing
6,000.
2A or 2B?
So A is 36, 36, I think you said you got, right?
Yes.
Yeah, but B, what's your answer for B?
63, 63.
Okay, that sounds reasonable. Anyone else?
Yeah, I got the same.
Okay, good. Good job. All right, let's do it together anyway. So it's a Harman Corporation. And that's question 2. Okay. So we follow the simple formula of finding break even, which is fixed cost over contribution margin. So we have 40,000 over 25 minus 14, and this should give us $40,000 over 11, which means it is 3636 bucks. Okay, so that's for the first part. For the second part, it is to find that quantity. We are no longer finding the break-even quantity. We are finding the quantity to make a profit. So if we call that quantity Q, then Q would equal to our fixed costs plus profit over our contribution margin. So since we have a profit of 30,000, so fixed cost plus profit would be 70,000, and that would be over $11. This should produce 6,364 bahts. So remember, we can't produce half a baht, right? So if once you have to produce anything more than a fraction, you have to round it up because you can't produce less than you won't make it. Okay, any question with regards to that?
Nope.
All right, so let's try the third one on the paper. And by the way, the questions that will be on the test will be similar to the questions that are on this sheet. So it's important to make sure you can do every question on the sheet. And do questions from the book as well. So don't just leave it up to the ones on the sheet. All the questions in the back of the chapters are good for practicing. All right, so question 3 says, Sean Pen and Pencil has fixed cost of 80,000. It's produced currently, its product, currently sells for $5 per unit, and it has variable cost per unit of $2.50. So Mr. Big, the head of manufacturing, proposes to buy new equipment that will cost 400,000 and increase fixed cost to 120,000. You say, although the price will remain at $5 per unit, the increased automation will reduce variable cost per unit to $2. So it says A, calculate break-even point before and after the new equipment, and then B, find the required sales in units to generate profit that represent 30% return on fixed costs before and after the equipment. All right, so I'll give you 5 more minutes to try this. In the meantime, I'm just go get my charger for my computer because it seems like it's dying. So guys, you have 5 minutes, okay? So try this one for me.
Will do.
Okay. Okay, guys, are finished?
Yeah, we can go ahead.
Okay, what answer do you have? What did you get for A?
For A, for the first or before option, I got 32,000.
Mm-hmm.
And then for the second, I got 40,000.
Okay, good. And did you get an answer for B too?
64,000 and 52,000?
For B,
Yeah.
I got 52,000, but I didn't get 64,000. But let's work it together and see what we get.
Oh, okay.
All right. Anyone else with an answer?
Oh,
All right, let's just work it together then. So Sean Pen and pencil, right? It's WN, right? WN. Okay, so before break even before, so that's before the purchasing of equipment, we have that would be 80,000, right? Our fixed cost over our contribution margin of $5 minus $2, so that's $2.50. And that would be 32,000 units. So let's just make sure to put that here. For after, our fixed cost will now jump to 120,000. Our variable costs would go down to $2. So we now have $3. So that gives us 40,000 units. So that's for the fixed cost in the first section of this. So now that's A, currency and fixed cost. So that's give us the answer for A. So B, we're now supposed to find how much units need to be sold if a company is to make a profit of $30 30%, right? So in that case, so the quantity in Q before would be 80,000 plus 30% of 80,000. This is an 8 over our fixed cost, sorry, our contribution margin of $2.50. So let's just bracket this here. 80%, 30% of 80,000. So that's 30% of 80,000. So when we work this out, we should receive, I have here 41,600 units. You guys can check it and tell me, but that's what I get. 41,600 units.
Yep, that's what I got.
Yep.
All right, so in terms of the next part, I'm just gonna skip to another page. This thing is not working so well. All right, guys, are you guys finished with this here? Can I clear this? Because my other page is not coming up so well for me to do that. So I'm just gonna clear this, so hopefully everyone has already, we need to take this down, take it.
Yep.
Okay, clear. All right, so we're now finding, so we're still working on B, right? And this is, we're finding the quantity Q after. And again, we're using the same method, right? So it would be 120,000 of fixed cost, right? Times 1.3. So I'm just using different way of calculating the same percentage. And of course, we're just dividing that by $3. And this should give you 52,000 units. Okay? Is that clear?
Yep.
All right, let's jump on to the next question. So Callaway Cab Company, it computes its break-even strictly on the basis of cash expenditure related to fixed costs. So its total fixed costs are 400,000, but 20% of this value is represented by amortization. So its contribution margin price minus variable cost for each is sold at $3.60. So it's telling you about what its contribution margin is. So you're actually giving it a contribution margin. And it says how many units does a firm need to sell to reach break-even point. All right, so I'll give you 2 minutes for this one. Are you guys are finished?
No, not yet.
So the only major difference in this question is that it's telling you that break even should be calculated using only cash fixed costs. So you're going to ignore costs that are not cash.
So we would just subtract the amortization from the fixed cost and divide it by the contribution margin?
Something like that, yeah.
Okay.
So what did you get for your answer?
I got 88,889.
You got 88,889?
Yeah.
Yeah, that sounds just about right. All right, so let's do it together. Okay, so it's cash related fixed costs. Its cash related fixed costs would be 400,000 minus the amortization, right? So its fixed cost is 400,000, but this include the 20% amortization. So 20% of 400,000. So this should give us 320,000 as our cash related fixed costs. So break even would therefore equal to 320,000. And of course, I've already given you the contribution margin. So you just use it, would be 3.60, and that would give us 88,889 units. Okay, any question with regards to that? All right, let's jump to the next question. Unless someone want to stop me with a question or a comment. All right, so let's look at air purifier. So it computes its break even strictly on the basis of cash again. So expenditure related to fixed costs is total fixed costs are 2,450,000, but 15% of this is represented by amortization. So again, this is similar to the one we just did. So it's contribution margin percent for this value. It's contribution margin price for each unit is $40. So how many units does the firm need to sell to reach its cash break-even point? So again, this is similar to the one we did before. So there's not a lot to it. So let's just quickly do it together so we can move on to the other two questions. So the cash break-even would be equal to, we have 2,445 minus 15% of the same number. What am I doing? So this would be 2,082,500 over $40, and that should give us 52063 units. All right, so let's move on to question number 6. So question number 6 is a little bit more because it's asking us to calculate the degree of operating leverage, degree of financial leverage, degree of combined leverage, and comment on the impact of a 20% increase, and does financial or operating leverage have the greater impact, and then break-even points in the unit, and break-even points considering interest expense as a fixed cost. All right, so we have the question and it gives us a sales because it gives us an income statement. And it says sales would be 20,000 units at $60 each. Contribution, variable costs would be 20,000 units sold at 30. So that's our variable cost per unit would be $30. So contribution margin 600,000, therefore contribution margin per unit would be $30 as well. They have fixed costs and so on. So we just need to calculate, first of all, the degree of operating leverage. Yeah, that's supposed to be sterling tire, but this board is not writing so well. So I'm not sure if it's my internet too slow or something. So things are not going to look as even as it should look on it. So we have a queue of 20,000 units, right? We know a price per unit, sorry, that's a P. Price per unit is $60. We also know that variable cost per unit is $30. So all these we can get from our income statement. We know that fixed cost is 400,000. We know that interest I would be $50,000. So degree of operating leverage was equal to contribution margin over earnings before interest and taxes. So our contribution margin would be, and this is like contribution margin in units because we're dealing with earnings before income and taxes. So we need that contribution margin amount that we'll get from our income statement. So if we look in our income statement, we will see that contribution margin is 600,000. And we will see that for earnings before interest and taxes would be $200,000. So therefore, we have D12 of, or DOL, sorry, of 3 times. So how about B? So that's A. And B is the degree of financial leverage. So the degree of financial leverage would be our earnings before interest and taxes over earnings before taxes. So it's 200,000 over 150,000 or 1.33 times. Okay, is that clear so far?
Yep.
All right, so let's move on to the degree of combined leverage. It's not working there. So I'm gonna clear this. Anyone needs to write something? All right, so I clear. So C asks us for the degree of combined leverage. So the degree of combined leverage as a C. Let me just rewrite it so it looks much better. Okay, so the degree of combined leverage is equal to contribution margin over earnings before taxes. So contribution margin was 600,000 and earnings before taxes was 150,000. So therefore, our combined leverage would be 4 times. Combined leverage could also be found, degree of combined leverage could also be found by degree of operating leverage multiplied by degree of financial leverage, which would be 1.33 multiplied by 3.0, and this should also give us 4 times. So either way would be correct, except of course if you made a mistake calculating one of these, then when you use this the second formula, then you probably would have gotten it incorrect. So the first one would probably be better in terms of that. So in terms of what do we get out of this? A 20% increase in sales will increase earnings per share by 20% times, so let's just write it here. So 20% increase in sales will result in earnings per share increasing by 80%. How do we find this? It's 4 times 20%. Right? So a 20% increase in sales, given the leverage that is being used by this company, will translate into 80% increase in earnings per share. And we find that by multiplying the degree of combined leverage by the 20% increase in share. So which one will have the greater impact? So operating leverage will have a greater impact because operating leverage was 3 times, while financial leverage was 1.33. So operating leverage would have the greater impact on the change in income, change in earnings per share as a result of increasing sales. Okay, any question with regards to that?
Nope, all good.
All right. Let's let's finish. I'm gonna clear. Anyone writing? Do I need to wait?
I think we're okay.
Okay, good. All right, so let me clear here. All right, let's go to D. And D is asking us for the break even. Of course, we know that fixed cost over contribution margin. All right, so let's just put 400,000 over 30. And that would be 30,000 tires. So E is just saying that we are going to include the interest as a part of the fixed cost. So if we're going to include it as a part of the fixed cost, then we would be just adding it to the fixed cost. So that would be 400,000 plus 50,000 over our contribution margin of $30. And this should produce 15,000 tires. Okay, any question with regards to that?
No, this stuff is pretty straightforward.
Okay. All right, so let you guys now try the last question, which is similar to the one we just did. So I'll give you 10 minutes to try the last question, and then we can work it together. Okay, you guys are now finished?
Yeah, hold on.
All right, so let's go through it together. So for the first part, A, or to find the degree of operating leverage. So our contribution margin, let's just write it, contribution margin over earnings before interest and taxes. So in this case, contribution margin would be 300,000 and earnings before interest and taxes would be 150,000. So that means that our DOL would be 2 times. For B, degree of financial leverage, so that should be financial, is equal to earnings before interest and taxes over earnings before taxes. That would be 150,000 over 90,000. That's 1.67. C. So degree of combined leverage would be, what am I doing? Degree of combined leverage would be contribution margin over earnings before taxes. And that would be 300,000 over 90,000. That should give us 3.33 times. And of course, we could do it by multiplying the degree of financial leverage by the degree of combined leverage. Now we won't bother to use that method this time. So it says a 20% increase, a 30% increase in sales. So if sales is increased by 30%, I'm just going to clear the board here. So hoping you guys have already take this down. Excuse me. So if sales increase by a 30%, so a 30% increase in sales will result in an increase in earnings per share of 100%, and this is from 3.33 times 30. You're not taking 30% of this, right? You're multiplying it by 30. It's going to increase by 30 times. So maybe the percentage on it is not so appropriate. Let's take that off. Oh, what happened here? Our board got cleared. All right, let me write this back. Oh, there we go. All right, so let's move on to next question. The next part of the question, which is D, and we are supposed to find the break even, which would be the fixed cost of 150,000 over their contribution margin per unit of $30. That should translate into 5,000 skates. And then for E, so again, E similar to the previous question that we did of incorporating the interest into as part of the fixed cost. So it's going to be 150 plus 60,000. And our contribution margin remains the same. And so this should translate into 7,000 skates. All right, so guys, there you have it. Are there any questions with regards to that?
Nope.
Okay, so for next week, for the test, you should practice more of the questions from the back of the book. Not the back of the book, the back of the chapter. So that should give you enough practice for the test. If you go back through these questions and you can do them all, and you can, these questions actually came from the back of the book. So if you do the ones in the back of the book, which include these, you should be okay for the test. Of course, I will send out 2 notifications. One I'll send out today just to announce the test, and then I will send out some how the test will be done in terms of whether we'll be using Lockdown browser or not, and how we'll be doing the test. I'll send that out by Wednesday or Thursday. So you should be clear as to what we'll do on Monday. All right, any question, guys?
No, I think that works for us.
All right, so if you have any question for me, you can always send me an email. If not, I'll see you guys. And please, guys, remember to watch the videos before the lecture, so that will better help you to to participate, not the lecture, but the tutorial, to participate in the tutorial and to come having questions to ask. Because I know sometimes I make mistakes in the videos. So sometimes just to clarify something I may say. So please watch the videos. Okay?
Great.
All right, guys, see you next week.
Thank you.